right, I think we're ready to go. So good morning, everyone, or good afternoon if you're coming to us from overseas. Welcome to today's event. This is with Lighter Capital. I'm your host today, Ian Gardner. I'm a VC with investment partner with Gelix Ventures. I'm also co-founded and helped run a local community group for startups called Innovation Bay. But more recently, Melissa managed to convince me to join Lighter Capital part-time to help them get established in Australia. I don't have many skills in life, but one of them is knowing lots of people. So I think that is helping here. Quite a few people that I'm joined with. I just want to do a quick intro to. So first up, we have Lighter Capital's fairly new CEO, Melissa Widner. She's been involved in the business for a while, but only in the last few months as CEO. So we'll maybe just do a quick sound check. Melissa, are you here coming to us? Well, you're on mute. That's the quote of the year.
Okay, here we go. I'm here.
Yeah. All right, good. Welcome.
Thanks, Ian.
John Prentice, all the way from, so Melissa is with me in Sydney, not in the same location, but we are in the same town. John is the head of their Lighter Capital's investment team director, John Prentice. So John is in Seattle. Welcome, John.
Thanks, Ian.
Now, just before I introduce Brandon and Danielle, yeah, just a little bit of background to how we all got here. So Melissa was managing partner with NAB Ventures, which is one of Australia's venture capital firms, backed by NAB, the bank. She was investor into Lighter Capital, and she sat on the board for a little while until she loved it so much that she jumped on as CEO. So I'm sure we're going to hear a bit more about that. Let me just quickly introduce Brandon and Danielle. So Brandon is the CEO and founder at Seamless. So Seamless, they're here because they're a customer, or they were a customer at Lighter Capital. So they've also got a very cool solution, which I think we're going to get into. Brandon's a serial salesperson. He's sold over, I'm just reading from your bio, Brandon, so I hope I get this right, over $100 million in sales. You're a technology entrepreneur, you're an author, you're a speaker, you've done a lot. So I'm looking forward to hearing what you're saying, but now you're CEO and founder at Seamless.AI. It's a software platform delivering the world's best sales leads. Again, I'm sure we'll get into that, but you've got 100,000 customers and counting. Terrific success story. And Danielle is here as well. So Danielle is the COO at Seamless, previously VP of HR and legal. So you're a qualified lawyer. Yeah, you're currently regional chair of the International Women's Insolvency and Restructuring Confederation. So that's pretty cool too. So we'll hopefully hear a little bit more about that. So, but welcome, Brandon and Danielle. So just before I throw to Melissa to run through this, just the way that this morning is going to work, Melissa and John will give a very short presentation, just giving some background on Lighter Capital and its unique offerings. I think as part of that, we'll get an overview of Seamless from Brandon and Danielle. And then I'll lead a discussion and Q&A for until we close. Encouragement to the audience, please ask questions. We've got plenty of time for them, so we will get to them. So let me be quiet and hand over to Melissa, who will take us through the Lighter offering. So Melissa, over to you.
Thanks, Ian. And good morning and good afternoon, everybody. I'm thrilled to be here talking as Lighter CEO. As Ian said, I've been involved with the company for a couple years. NAB invested in Lighter in 2018 with the intention to partner with them in Australia because there wasn't a similar offering here. And we just launched the partnership with NAB last week. So I'm just thrilled that we're launching here. It feels like a long time coming, but I know it's going to be a very successful partnership. Just a little bit for people who don't know about Lighter, and as an entrepreneur, as a former entrepreneur, their business model really resonated with me. Lighter allows companies through debt financing, through our product, which is primarily called an RBF, a revenue-based financing product, allows companies to raise capital while retaining ownership and control of their companies. It's completely transparent. There's no board seats, no onerous financial covenants. It's straight debt, and the payback in our RBF product, which we'll get to a little bit later, is tied to a company's revenue or performance. So it really matches, it has the effect of really being there to work with the company at the time they need it. And we saw this in spades during COVID, when so many companies had their revenues just smashed for a short period of time. Companies that had our RBF product also had, you know, a much lighter loan burden during that time. And we'll get into that a little bit later. Lighter's been around over 10 years and has been doing this kind of lending since 2012 to SaaS companies, primarily in the US. Just this year, we launched in Canada, and now we're launching in Australia. And we've done over or close to 800 loans now to 400 companies. Most companies that we provide loans to take more than one from Lighter. There's a lot of companies on this slide, but it tells such a good story. So who are our typical lendees? They fall really into 3 categories, but in terms of where they go, it also falls into sort of 3 scenarios. And the first, I would say, is there are companies that are completely bootstrapped. They don't want to take any outside ownership. They don't want to bring anyone else onto the cap table. And Lighter's a really good solution for them. We have lots of examples of companies that have raised multiple rounds from Lighter. One of our companies raised up to 9 rounds from Lighter Capital, and they never had to take any dilution. The founder was able to grow the company to $10 million in revenue and still owned 100% of it. Other companies are VC backed or just pre-VC backed. So most of the companies that we lend to aren't VC backed at the time that they take their initial loan from Lighter, but it might be a bridge to get them to that round. And one story recently, one of our companies called, oh, John, you're gonna have to help me out here, but was it Fishtown? It's not on the slide.
Yeah.
Or Fishtown Analytics.
Yep.
They took 2 financings from Lighter and then went and got a venture round from Andreessen Horowitz and then another one from Sequoia, you know, 2 of the top tier firms. And they were able to, you know, get to the stage where they were attractive to those top tier firms by using Lighter capital to get there. And then other companies in our portfolio will use our capital to get to an acquisition. Steelbrick is one that took a couple loans from Lighter and then was acquired by Salesforce for over $300 million. We have a few products in Australia. These are just examples of companies and the types of products they've taken from us. And most companies take more than 1 loan from Lighter. In fact, I think the average is 2.1. John, correct me if I'm wrong, but you know, we've had companies take as many as 9 different tranches from Lighter. We also have companies that will use us in conjunction with a venture round or an angel round. In fact, this is pretty common and becoming even more common in this COVID era, where, you know, valuations have been somewhat depressed, and we're seeing companies come in and take some debt financing to get through this time when their revenues are down. They're not hitting plan, you know, due to COVID, but we know, especially in certain categories, that they will rebound, and they're using debt to get them through this time. We have 2 main products. The first one that has been our product for the last 8 years is our revenue-based financing. And this is a 3-year loan where the amount that is paid back is dependent on the revenue. It's a percentage of the company's revenue every month. So we'll target, say a company borrows $1, they might pay back $1.30. And they'll pay that back over 3 years, potentially less. if they end up growing a lot faster than they anticipated, but the payback will happen as a percentage of revenue every month. And again, I talked about this a little bit earlier, but this has been a great product for companies during COVID whose revenues really suffered or are suffering right now due to shutdowns. We have an events management company. This is a strong company that's out there making acquisitions, but their revenues were down quite a bit because there aren't a lot of events, and consequently the amount they're paying on their loan is down a lot, so they don't have that loan burden. And we know they'll bounce back. When they bounce back, the amount they'll pay, because it's a percentage of revenue, will go up. Another one of our companies is a ticketing company, again tied to events, really hurt during COVID, but they're surviving during this time. Their loan burden is very small because it's a percentage of their revenue. And when they, when events are open again, they will be back in business, and the amount they're paying to Lighter will correspond to their revenue. And then we also have a product that we just launched a few years ago. Is just a traditional term loan. And this is typically taken by companies who are a little bit further along, and they just want to know the set amount they're going to have every month. So they might have more predictability in their revenue stream and choose to go down that route versus the variable revenue-based financing. And I'm going to turn this over to John now to discuss the different funding options.
Yeah, this slide is supposed to just kind of illustrate where we sit as far as working with VC-backed companies, bootstrap companies, and companies that do a combination. So 2/3 of the companies we work with are bootstrap pre-Series A. So it's usually the most kind of common time that we get involved, where maybe it's an entrepreneur that doesn't want to raise equity at all. They want to delay the point that they're going to raise equity. Or we have companies that will utilize us that are in between financing rounds. So they're in between, call it a Series A and a Series B sort of thing, and they're not ready to go out to the market and raise equity capital. I think something that Melissa said earlier I'd want to highlight too is that obviously right now, I mean, the VC market, the equity market's a little bit less favorable. It's hard to connect with VCs too without being able to meet in person. So we actually hear about this a lot, where a lot of companies are just trying to push out the next equity financing by 6, 12, 18 months, and then they're going to go back out to the market and then start looking at options. Go to the next slide. Yeah, and then I'm going to spend just a couple minutes walking through kind of at a high level our credit criteria to give everybody an idea of the kinds of companies that we focus on. And then we'll talk about Seamless.AI, which I'm very excited to talk about as a use case. And we also got Brandon and Danielle here with us to talk about Seamless too. So, we can kind of think about the sort of companies we work with in kind of 4 credit pillars. One, it's all tech companies, recurring or kind of reoccurring revenue models. We love B2B SaaS models. We'll do some B2C subscriptions too. Also kind of any kind of tech kind of contracted services. Don't do as much on the transactional side. The other piece with our financing model is that you need to be generating monthly revenue, right? So this isn't necessarily a good option for a pre-revenue company. We view that as more kind of equity risk profile. So we do need to see companies generating at least, call it 15,000 USD a month in monthly recurring revenue, or roughly 20,000 AUD in monthly recurring revenue. The other piece is capital efficiency. So we like companies that are close to break even. You don't necessarily have to be profitable. We don't require that. It's not like a bank where we require profitability, but we like to see that path to break even in the foreseeable kind of future, call it 6 months or so. And then you have good liquidity too. And that's for a couple of reasons. One, so the reason we're different than a lot of other venture debt lenders is we don't require equity sponsors. We're not really underwriting to the fact that you've raised an equity round, right? That you've raised a Series A financing as an example too. So we want to see that the company can be kind of self-sufficient as is. The other related to the comment about revenue is just a diversified customer base. So we need to see at least 5 customers minimum. No one customer more than 1/3 of overall revenue, and then good renewal history. So you've had at least 50% of your customers renew, as an example. And give you an idea too, as far as kind of the average company you work with, it's probably in kind of the 1 to 4 or 5 million annualized recurring revenue is usually when we work with most companies, and we'll scale up with them as they continue to grow. So we have Seamless.AI here today, which I'm really excited about. And Brennan and Danielle will also talk about kind of the platform technology, which is really cool. So they're a US-based company based in Columbus, Ohio. Just absolutely doing phenomenal, pushing 25 million as far as annualized recurring run rate. They have a really cool platform that's an AI-based SaaS platform that helps sales professionals identify and get in touch with prospects, which I'll let them talk a little bit more about. So they came to us earlier this year. They'd raised 2 million plus at that point from super angels and micro VCs. And Brandon and Daniel as a team were very sensitive to dilution and control at that stage, weren't really ready to go out to the market and raise an equity financing. So they took 2 term loans from us, up to 2 million total USD over the past 6 months. And it was all non-dilutive funding. We didn't have a warrant piece associated with our financing model either. And that really enabled the company to scale while making investments in sales, marketing, and really more than double the annualized recurring revenue. And it really put the company in a really great position, especially you think about the past 6 months, right? And everything that's gone on. And so the company is really in a really great position right now if they want to go the growth equity path or they want to continue to work with us. And really that's what it's about, is we're really hoping to provide optionality to companies, right? So just like we've done in the US with a company like Seamless and almost 300 other companies throughout the country, we're open to do the same in Australia. And I don't know, Brennan, Daniel, is there anything you would want to add on kind of the Seamless side?
Yeah. Hey, everyone. Thanks. So first off, thanks so much for joining us today. Thanks for having me, Lighter Capital and Ian. And thank you, Melissa and John. What's awesome about these guys is our company was at a pivotal time of growth, and we needed a funding partner without giving up equity. And if it wasn't for partners like Melissa investing in the fund and leaders like John, who knows where we'd be right now. And it was just amazing. I've got a history. I've pitched over 347 VCs. I interviewed about 15 venture debt partners. So, by the way, I'm the CEO and founder of Seamless.AI. We find everyone's emails and cell phones and insights. So for me to contact and prospect anyone is seamless. It takes a second. So I was able to, when we launched our company, it was really easy for us to prospect VCs, but we never really loved the process of going pitching investors. It was just always a grueling due diligence process. And, you don't know who you're working with and you name it. And then, when we were getting at a mass scale of product market fit, we were like, okay, we want to take on some venture debt funding is what we call it. And we interviewed Lighter among the 10 to 15 providers, and they were just the most personable, best to work with. And also, we evaluated price and we evaluated partner, and it was the best price with the easiest, best partner to work with. And we're just really grateful because we were able to use that capital to grow 300% insanely fast during the worst economic time of our history. And we went from serving, 40 to 50,000 customers to now serving 120,000 users and customers. So we could dive super deep into the specifics on Lighter Capital, how we evaluated the market, why we chose them, why we chose this vehicle, you name it. But I can't say, it's always better to hear it from a customer than, the person trying to pitch the product. But I've got nothing but amazing things to say. We wouldn't be where we're at. We went from 30 to 40 employees to over 125, 130 employees during a pandemic. And there's no way we would have gotten there without the partnership of Lighter Capital. And we were able to use that capital to then generate revenue to then pay off the capital that we owed Lighter Capital. So it was just amazing. And I wish I could have taken more even, because I would have loved to just ride it for till 100 million. But that's out of their business model. But maybe Melissa, you could work with the partners and try to figure out how instead of 2 to 3, we scale it to 100 mil, and I'm in.
Absolutely. Well, Well, thanks so much, Brandon. And it's so great to hear stories like yours. It just reminds us, why we do what we do every day. And there's just such a mission to this company, that keeps all of us going. I remember when NAB made an investment, like I said, over 2 years ago. And one thing we did, which we do with every investment, is we do customer calls, customer due diligence calls. And we do this at random. We don't ask them to send us their best 3 customers. We look at all their customers and select, I think we spoke with 11, and it was just hard to, the stories were all similar to yours, just in terms of, what a great experience it was for these customers. And it's not just getting debt funding, but it's actually getting a partner that helps you grow your business. And people like John and our other IT professionals really work with the company to understand what their needs are, and also make introductions to VCs and larger venture debt providers when the time is right. So, we really just consider ourselves a pivotal piece, part of the journey.
Yeah, and I think what was cool about it was, we were in between this seed and Series B or C round, depending on the growth with how much, we were scaling and growing fast. We got lucky where we didn't have to raise a ton of venture capital money to scale. We believed in selling our products and services and being bootstrapped and scaling with sales to grow our company versus borrowing a ton of money. But what was awesome was, for us, we didn't want to take on a middle round where we would have to sell. Typically every round, a venture capitalist wants at least 20%. So it's okay, you do a seed round, they're going to take 20%. You do a Series A round, they take 20%. You do a Series B round, they take 10 to 20%. You do a bunch of those rounds, eventually the founding team and those partners are going to own virtually nothing. And then the dream that you had will eventually fizzle away because you're going all out every day, 5 days, 6 days, 7 days a week. We work 7 days a week all out. And if we had no ownership in the company, I think the company wouldn't be where it's at. So what was amazing was being able to find an option. And it's interesting because the banks, you'll talk to these banks. There's a lot of them out there. And I don't know if there's a lot of them out there in Australia, but all these banks are like, hey, you're doing great. You're over $1 million, or maybe you're $500,000 or $2 million or $3 million. Okay, we will totally do a deal with you, but we want a big Series A VC on the deal as well. And you're like, okay, hold on. You want me to go fundraise a deal that guarantees you'll get paid if something goes wrong, and then you want me to borrow from you when I don't even need your money because I've got the bank? I'm like, this deal doesn't make any sense. So what was awesome was working with Lighter Capital. Also is the breadth. You could take a small amount, you could take a large amount, you could do it in tranches, and I know their business is evolving with the market dynamics, but it was so flexible. It was like, hey, Brandon, what's your P&L? What's your CAC to LTV ratio? What's your MRR and ARR? How much does it cost to acquire a customer? How much money do you need to keep growing the company to ensure that you're safe while you're also acquiring companies and customers to expand growth? And I loved the flexibility. And lucky for us, we took a small tranche, but then we were growing so fast. We're like, oh gosh, we need more. And then we need more. And then, the company just kept growing at an insane amount of speed, and we're grateful that we wouldn't have been able to get there. But I just find it interesting. All these banks want you to have venture capital funding to back it. All the venture capitalists will invest, but they want to take 20 to 30% or 10 to 30%. And then if you do a bunch of those, you'll own nothing. So I believe this funding vehicle, Melissa, I think I'm going to be like one of you guys, one of you. When we IPO, I'm going to be like, okay, hey, John, Melissa, yeah, let me be a partner, and I'm going to throw 50 million into this deal because it's exactly what every entrepreneur should use to grow their company. But first, nail your unit economics. If you don't know CAC to LTV ratio, if you don't know the CPA, the cost to acquire a customer, you got to know the dynamics of the market before you borrow money. And once you have that down, you're good to go.
Yeah, well, thank you, Brandon. And it's just like I said, this is why we do what we do, to be able to help and work with entrepreneurs like you. It's just so rewarding.
Yeah, and it allows entrepreneurs, and Danielle can talk about this, but we spent so many endless weeks and months on road shows raising venture capital funding, where this was just like, okay, let's review your bank statements, your balance sheet, your business plan. Okay, I'm gonna give it to the committee. Okay, that's good. Everything checks out. Let's do it. Let's do this. So I loved that I didn't have to spend Danielle and I as busy C-suite trying to run a book of business of 40,000, 50,000 customers at the time. We didn't have to waste endless hours on the road showing, you name it. It was just awesome.
I love that 347 pitches, that that number. I remember when I was pitching for my company, you remember, at least I did, I remembered every single meeting I had with every VC and what they said. And on the other side, as a VC, you don't remember every meeting. But it's just a reminder that entrepreneurs are out there pitching their babies and having to kiss a lot of frogs. And at the end of the day, you did this without taking any dilution.
Yeah, it was awesome. I remember all those banks, and you don't try to maximize shareholder value and returns for the people that said no. You do it for the people that believed in you, your users, your customers, your investors. But there's always a little piece of you that says, "Hey, I'm gonna remember you said no, or you gave me a hard time, or you were the bank that loaned me money, and we're gonna make it big."
But Brandon, you still had some early investors like the super angels. I mean, they must be pretty happy.
Yeah, and I wouldn't even call them super angels. So we've got a few super angels for sure, some game changers, but we also had some really awesome venture capitalists that just wrote smaller checks, like $500,000, $250K checks. Newark Venture Partners, Right Side Capital, 9 Mile Labs, Jumpstart Angels. These groups are amazing. We had some super angels that I can't even mention, like Guy Kawasaki, and another one that I'm not going to mention. But we did get some money, but we did that deal in 2017 to hire the engineers to build our product. So we pretty much wanted to just raise money to build the MVP, launch the MVP, and then fuel the growth with sales.
Yeah. All right. Well, I think we are. John, Melissa, that was the last slide, I believe. So I don't know whether we want to keep that up or kill it. And there's your beautiful pictures. But
just go up to the front. Sorry.
Or we could kill the slides and then just have all of our beautiful faces while we do the. Yeah, there we go. How's that? Look, a bunch of questions, and look, thanks to the audience for the questions. So maybe we'll actually just jump straight into that. Melissa, this might be for you. Ram Naresh, I mean, we'll just jump in no particular order, but can you provide financing for listed companies in the ASX?
Yeah, I don't see why not.
John?
It's something that we haven't done in the US because typically companies are a lot larger when they go public, but in Australia, you have companies going public with a couple 100,000. I mean, I think Afterpay went public when they had 200,000 in revenue.
Yeah.
I'll comment on that too. So we have not done that in the US. Obviously, the listing requirement in the US is much different. We have explored it in Canada and talked about it in Australia too. So, I mean, in the past, it has been a limitation because we have had US-based kind of capital providers, but in the future, it may not. But obviously, the market is much more dynamic in Australia and Canada as far as kind of earlier stage companies going public.
Yeah. All right, let's keep rolling. Zach King, again, a transactional one. John, looking at the Australian space, if a company's hitting the minimum milestones you outlined, so, fitting in that credit, those 4 credit pillars, how much time in market would you look at as minimum? For example, 2 years of customers, etc. So yeah, what's the minimum lifespan that you would lend to?
Yeah, great question. So generally we like to see that a company's been incorporated for at least a year, 6 months of revenue history, and then the latter 3 months we like to see at that 15,000 or 20,000 AUD as far as monthly recurring revenue. So as long as the company kind of hits that minimum milestone, we're happy to talk to them and start the conversation and see what we can do.
All right, cool. A few questions in from Alan Beatty. I think Alan's in Hong Kong now. Used to be in the sector here when he was a VC. A few questions. So apart from the positivity, you know, this market needs debt. It's definite positive. I'm surprised that you are pre-Series A on a revenue-based finance model, as the revenues at that stage are not mature and can be very lumpy. So that's probably not so much a question as maybe there is a question in there. And then, are you regulated? In fact, why don't we just run with those two? Melissa, do you want to comment on that?
Yeah, well, I guess the first comment, we've been doing this, you know, for almost a decade. So there's a lot of history and our loss rate. I mean, no one in this space, I think, even comes close in terms of having the track record. We have a very low loss rate of under 2%, about 2%. In terms of lumpy revenue, we don't just fund any company that has, you know, 15,000 in MRR and has been in business for 6 months. What our underwriting tool really looks at is churn, strength of customers, and customer concentration. So, you know, if somebody came to us and had 50,000 a month in revenue and it was all, or most of it was one customer, it probably wouldn't fit because there is too much risk there if they lost the one customer. Although we have funded companies that have customer concentration, I mean, in those cases, we'll actually have a conversation with the customer and assess, you know, like a VC would assess, you know, how strong is that contract. In the second, yes, there is some regulation. Business lending isn't as regulated as consumer lending. It was a little easier in Australia to get set up than in the US. And that's just because in the US, there's different rules for all 50 different states. And in fact, there are some states that we cannot lend into in the US.
All right. Maybe I should ask this. He's got a very sort of inside baseball question. On your liability side, how does this work? Funding, liquidity, maturity ladder, etc., to ensure your own longevity. So how is it working on the funding of Lighter side?
You mean in terms of?
I guess it's in terms of who's providing the capital to Lighter itself. I
Yeah.
think that's what Alan's asking.
So we have worked with, since inception, 3 different debt facility providers. But in Australia, the largest provider for facilities like this by far is NAB. And we are, you know, we'll hopefully someday grow into have a large enough book in Australia to bring NAB on board. NAB's an investor in Lighter, but you know, typically the debt facility would, if it's a larger facility, there would be layers of funding. So there would be a bank sitting at the senior level or an insurance company at a really low rate. And then there would be some mezzanine financing that could be institutional investors, family offices, high net worths at a higher rate. And then there would be the company itself, so Lighter taking on the first loss. So in any of our facilities, we take on the first loss capital.
All right, look, let's look. Thank you everyone for the questions. Keep them coming. We've got some time, but I've got some other ones. I do want to involve Brandon and Danielle, but just before we do that, it's probably worth, and we didn't really talk about the history of Lighter. So maybe John, I might throw to you on this one. I think you've been around for the longest for all of us, but what is the background to Lighter, and give us a bit of the genesis?
Yeah, I guess I'm a little ancient at this point, 6 years. Yeah, and I'll speak a little context. I think Melissa can probably add some color too. So Lighter Capital was originally started in 2010, 2011 timeframe. And we're based in Seattle, Washington, and actually started as kind of a spin-off to a well-known VC in Seattle that does West Coast investments called Voyager Capital. One of the partners there, Eric Benson, actually read an unpublished academic white paper by Clayton Christensen, who wrote The Innovator's Dilemma and a couple other famous books. And it was about applying this kind of concept or notion of royalties and revenue sharing agreements to tech or venture finance. So obviously it's a facility structure that's common in, you know, media, pharmaceuticals, oil and gas. So he was kind of intrigued by it. And he also started talking to another gentleman locally in Seattle, who's kind of a well-known serial entrepreneur and angel investor, and ran a couple accelerator programs in Seattle, and he was kind of experimenting with different financing models as these B2B SaaS companies were coming through. So he started kind of experimenting with this royalty revenue sharing arrangement. And the two of them started talking, Eric and the gentleman who was a serial entrepreneur and local angel investor, and thought, gee, this has interesting wings as a potential company. So Voyager Capital actually seeded the company in the investment. And then the gentleman, Andy Sack, jumped in the CEO role and started the company. And there was some kind of experimentation at first as far as kinds of companies. So they, funded kind of specialty foods companies, events companies, also B2B SaaS companies. And it was kind of through that experimentation, they figured out this B2B SaaS model is what made a lot of sense for this sort of royalty revenue sharing arrangement. So yeah, that was around 2010, 2011 timeframe. Flash forward to where we are now, worked with almost 400 companies throughout the US and now global and Canada as well as Australia.
Yeah, no, it's pretty exciting. Look, we should talk about Australia. We are here. So maybe an easy question first for Melissa, like why Australia? Why is now the right time to launch into Australia?
Yeah, well, Australia, I think, is the perfect market right now because there is, I moved here about 11 years ago, and there wasn't much going on in the VC community, but now we've got a thriving venture capital community. But there still is, there's I would say even more so than in the US, there is there's a hesitancy to bring other investors onto a cap table. There's a lot of entrepreneurs, and we have a lot of really successful large companies here who never raised any outside capital and never took any dilution, and that's kind of a badge of honor in Australia. So there might be, we think there's probably more demand, and there's not any product that's like Lighter's here. And there wasn't when we started in the US. There have been a lot of copycats. Since we started, Lighter's still the leader in the space. But there are some venture debt funds, and it's great. We work closely with them. They tend to have much bigger check sizes. They come in conjunction with the venture round and do take some equity, do take some warrants. So we're filling a real need here where there's not really other alternatives.
Yeah.
In terms of timing, we should have done it a couple of years ago. I think when NAB made the investment 2 years ago, we were ready to go. So I'm glad we're finally launching here.
Yeah, no, I agree with all of that. I mean, it's the ecosystem here is very different to how it was even 5 years ago.
Yeah.
And I think the level of sophistication and understanding and maturity of this capital markets is ready. So that's part of the reason I jumped on. I'm pretty excited about the offering. Danielle, Brandon, are you actively selling into Australia? Have you got much understanding of the local market here?
Go ahead, Danielle. Danielle's best friend married a famous rugby player.
Yeah, and lives out in Sydney. So maybe we will take on Australia next.
Well, yeah.
Right.
Once they roll out this vaccine in the next few weeks, then you can come and visit.
I know we very much are looking forward to being able to travel again. It's been very strange. Brandon and I were used to doing road shows and speaking at different events over the last couple of years. And now we've not traveled since, I don't know, I'm embarrassed to say, since the beginning of this year.
Yeah, wow. I suspect it'll be more in a few weeks, but certainly this time next year, I think we can probably, fingers crossed, say that we could host you down here. But yeah, so like, what is your view of Australia?
I know that Lighter's now have sponsored all these sports teams. I'm like, man, I want to get out there. But the platform's global. We've got users at companies both large and small globally, which is incredible. And we're excited about the opportunity for growth and excited to also see the expansion of Lighter into the Australian market. I think it's a huge market opportunity, and your economy is booming, and I think it's perfect for a lot of companies that may be in need right now.
Yeah.
Yeah, and let me add too.
Yeah,
so we're actually a Seamless user too, so I can give a strong endorsement of the product. We love it. especially during this time where honestly, like it's harder to connect with people, right? Like and how do you find like mobile phone information if people are at home, you don't have, office phones. So we've been using it as a prospecting tool. We don't have a traditional kind of events and conferences that we used to rely on. So it's been great. And we're also using it for our expansion in Australia. So it does have international compatibility.
Yeah, great. Yeah, that's interesting. You say it's harder. I mean, in one sense it's harder, in another sense it's easier. If you do have someone's contact details, then the chance of getting them to do what you ask, i.e. jump on a call or turn up at an event, is actually higher. This is our observation of this year. So
just to say the ROI on Seamless's product is, I mean, it would be a week or two, right, Brandon? It's just, I shouldn't say this as a customer, but you probably should raise your prices. Because the value that you get from the product for the cost, which is very minimal, is incredible.
Yeah, I mean, I think we both provide similar products. Like if you need capital, Lighter is going to be your best partner. If you need sales, the only way to get the customers you want, the investors you want, the life you want, is to have the list. And the only way to build the list is with Seamless. And you could connect with anyone in the world. And that's our mission: positively impact 1 billion people, connect to opportunity. It's extremely affordable. We wanted to commoditize the ability to connect with anyone. If you're a startup CEO, entrepreneur, you should be able to connect with Melissa, John, Bill Gates, Guy Kawasaki, anyone that you need to connect with. And we're providing you that opportunity. And we're just grateful. I think probably both of us here, Melissa, I don't want to put words in your mouth, and John, but it kind of feels like we finally showed up to the world's greatest party. And I'm just working as hard as possible so the party never ends.
I like it.
World's greatest party. I love it. All right, let's take a couple more questions. One is in from an anonymous. That's designed to trip you up. How strict are, this is probably for you, John, how strict are you in only lending to tech (SaaS) companies versus adjacent companies, e.g. food tech?
Yeah, I mean, historically the focus has been B2B SaaS, and like I said, we'll do some B2C subscription models, tech services too. So we will look at some adjacent stuff. For us, it's a matter of just that revenue stream being kind of reoccurring or kind of contracted, predictable in some manner, and then high gross margin. So having kind of an optimal cost structure. So usually we like to see gross margin of 50% plus. But we're talking about different verticals. We could go into, e-commerce as an example, right? There's a sector that's, obviously boomed in the past 8 months. So definitely looking at these sort of adjacent areas.
All right. Melissa, another anonymous question. What's Lighter's diversity mandate? I know you're passionate about this, but any investments in female founders, BAME?
Yeah, I love that question. As you know, I'm the co-founder and chair of Heads Over Heels, which is an organization in Australia that works with women entrepreneurs running companies with high growth potential. So this is an area that I've been very passionate about for a long time. But one of the first things that we did when I got into Lighter is we looked at our entire database of companies that we made loans to and or provided funding to, and looked at how many were run by women, or how many had, and we only looked at the gender diversity. There's a lot more we could go into in diversity, but we looked specifically at gender, and how many had a woman in their senior management team. And the numbers, not surprising, were pretty low. It was under 15%. And now something that we're working on is what's the performance of those companies versus just in our portfolio versus the ones that have no women. We know there's a lot of studies out there that show the venture-backed companies that have diversity in their management team perform better than those that don't. We're looking to see if our portfolio mirrors that. So great question.
Yep. No, that's why I wanted to ask it. I had it on the list anyway. So yeah, thank you for that question, whoever you are. John, look, you and I have been talking to the local founders and ecosystem for a little while now, not a huge amount of time, and that's now starting to ramp up now that we're officially launching. I mean, what's your observation? I mean, you've been in this game for what, 6 years with Lighter. So any observations of what you've seen in the Australian market with the Australian founders versus what you're seeing elsewhere?
Yeah, I mean, I've loved it. Obviously, it's been an interesting time to expand globally too, in terms of what's going on in the world, and talking pandemic of Australia versus here. But besides the point, but I think one of the observations to me has just been the capital efficiency, and I don't know if that's just kind of the cultural mindset of how Australian entrepreneurs think, or just the lack of capital, kind of a combination. But it does seem like Australian entrepreneurs are very capital efficient. They're much more conservative with their business, which in a lot of ways is a better fit for our financing model. They're also a lot quicker to think about global expansion, is something else that I've noted. So they're very quick to think about, I want to expand to the US, or I want to work with a partner like Lighter so I can expand to the US, which makes sense. I mean, obviously, the Australian market's a smaller market. But those are two of the takeaways that I've really noticed.
And Melissa, I might ask you, similar question, but maybe with a different. I mean, you've been involved now in the US as a VC. You'd lived in Seattle for quite a long time, and you've been here now for 12 years, but still with a foot in both camps. So, again, any observations on the differences between Aussie founders and US founders?
I definitely would echo what John said, but there is, in the US, there is more of a push just for growth at all costs, which can put a lot of risks on a company. And a lot of that does come from the venture investors who, I've been in venture for a couple decades, and you see that, sometimes when you take venture money, you have to grow, and you have to grow quickly. Venture firms aren't interested in getting a 2 or 3x. They need to get a very large return on a couple of their companies, and they're pushing all their companies to get that large return. And a lot of times that puts a lot of risk, unnecessary risk, on the companies, and it actually, pushes them to fail. And I would say, in terms of differences, that push isn't as strong here. You have venture firms that are thinking 2, 3x, and that would be okay. You don't have that kind of thinking in the US. So to John's point, I think that does lend itself better to our product potentially here.
All right, great. All right, let's take another quick question from the audience. So Sam Hassan, is there a minimum and maximum amount for lending with Lighter? John, probably jump in on that one.
Sure. Yeah. So the minimum loan amount we'll do in Australia is 50,000, and then we'll actually, in the US, we go up to 3 million USD. So it's roughly 4.25 million AUD in Australia. So in that range of kind of financing amount, I would say initial financing, we typically don't like above kind of 1 million amount, and they're always lending, just for little context, at a 3 to 4x MR, or call it a third or fourth of your annualized recurring revenue. So take your monthly revenue, your monthly recurring revenue, time that by roughly 3, maybe 4x on the high end, and that's the amount that we can lend.
All right, nice and clear. Yeah, I like it. Yeah, I want to keep making sure that we've got Danielle and Brandon in here. So I mean, this may, you can probably pitch in here. I just want to ask a question about the due diligence, like the process involved. Assuming that we find a customer or prospect, they're keen, got great business, they want to lend, the terms are kind of agreed. What's involved in going from there to having the cash in their account? So, I mean, maybe John from an operational standpoint, and then Brandon, Danielle can jump in from a customer standpoint, just how that felt. So John, or yeah, anyone.
Well, first off, let me say that Brandon and Daniel are amazing. Both very super easy to work with, and it really helps on the diligence side when you're working with entrepreneurs that have all that information on hand, right? They know, I think Brandon talked about churn and CAC and LTV and all those metrics, and they can easily pull that information. That really helps expedite the process on our end. But from a process perspective, and I'll let Brandon and Daniel speak to kind of their experience, typically we're trying to get out kind of initial terms within like a week or two. From the point of getting financial statements and kind of key metrics. And usually it's another couple weeks to solidify that in formal loan documents. And some of this depends on the company and kind of the loan amount size too. And then a couple more weeks to close altogether. So it is not your 6-month kind of VC diligence process. We're not really spending as much time looking at the product and market technology because we don't not only require the equity sponsors piece, but we also don't have the warrants. So it's really focused more on understanding kind of the unit economics, recurring nature of revenue, and contract structure at the core.
And Danielle, I mean, I think you must have been involved as the in-house lawyer as part of this, but from a customer perspective, any observations?
Yeah, I will say that it's much easier to work with someone like Lighter Capital, right, than your traditional, as John was just mentioning, a VC firm. Having been on both sides of it, the VCs will ask you for diligence for months and months on end in every single document. Whereas with Lighter, you're providing all of the relevant financials that you're looking over with your CFO, with your CEO. I mean, they were things that we were already preparing internally for ourselves. And everything is done really nicely electronically, which is also a huge plus. I will say in terms of the servicing, understanding our loan amount, when our payments were due, how we could take on the next tranche. It was very seamless, easy to communicate with Lighter, their servicing team, using the portal, which are all really important things when you're an entrepreneur, because you have so many things that you're trying to juggle and to keep on your plate. And being able to take on debt financing and have it be simplified in a way that you can understand it and you know how much you're paying each month, it was really helpful.
Yeah. All right, good insight there. In fact, there's a follow-on question which is linked to that from Zach King. Melissa, I might throw this to you. It seems that Lighter is specifically moving away from ownership control aspects, which you'd expect with, VC investment will want ownership and control in some form. But does Lighter offer advice, support, intros after investment?
Yeah, absolutely. And one of our largest investors is Silicon Valley Bank. So that's a great connection in the US for companies that grow up and are growing into venture debt. But we have strong relationships with VCs, and John can talk about this, for companies that do want to go down that path. That in fact, it's something that we're doing more and more in terms of making introductions for companies that do want to go down that path. And because and actually it's a really good question, because something we were just talking about last week is getting our portfolio companies together to do some shared learnings. So, most of our, in this Zoom era, it's just been great because we're able to get people together virtually. It's no longer, dependent on geography. But most of our sessions have been around financing. But what we're finding is, we've got companies like Seamless that have a lot of expertise in, a specific area. Let's share that with our other portfolio companies, or marketing. Let's share that with our portfolio companies. So that's something we have done in the past, but going forward, we're going to do it in a more systematic fashion. So, Lighter's not just a place where you can, get financing, but it's a place that you can go to get information from other successful companies and share learnings.
Yeah, great answer. John, quick question, anonymous question. Will you lend to companies selling to the major supermarkets and other retailers? And I guess by, the extension to that question, are there any other no-go areas that we should know about if that's a no-go area?
I'm sorry, the question, it was about supermarkets?
Yeah, would you lend to a company that sells to the major supermarkets? And I guess in Australia, that's Coles and Woolworths and other retailers.
Well, we'll certainly lend to companies that sell SaaS solutions into those verticals. We have some companies that, do like analytics for retail, that sort of thing. That space, for obvious reasons, has been a little bit tougher unless it's fully kind of on the e-commerce side. So we'll definitely look at it if it's a SaaS solution for any of those areas. I think the other question was about areas that we won't lend to, right?
Yeah. So are there any black areas in that credit box?
Yeah. So anything kind of drugs and alcohol. So we'll actually sell software to the alcohol industry, but it can't be like I've had companies approach me that are like wine subscriptions. As fun as that seems, and I would like to partake in the diligence, we're probably not lending to those companies. Same with anything kind of drug, marijuana related, firearms, although I don't think that's an issue in Australia per se. There's another one too. So.
All right, look, we're pretty close to time. I want to make sure we're out here in time, and the questions are drawing up a little bit. So maybe I'll make this the last one, and I'll throw it to you, Melissa. Yeah, what's next? I mean, you're just taking on the CEO mantle. We're launching in Australia, which we're kind of talking about today. But what's next on the roadmap for 2021 and beyond?
Yeah, and it's one of the reasons I was excited to join, and also, working with Lighter for the last couple of years, seeing a company that's done so well in this area. And at NAB Ventures, we met with, I don't know, over 3,000 companies. A lot of them were in the alternative lending space, and saw a lot of companies doing really interesting things in alternative lending, and thought, why can't Lighter go into some adjacent areas? So one of the things that is on the roadmap for 2021 is to expand beyond SaaS and to use some of the learnings that we've accumulated over the last decade to help companies and other verticals that don't have access to traditional bank capital, but have data upon which we can make credit decisions.
Yeah, and I think it's safe to say, I mean, we are open for business, so we are keen to hear from the Australian founder ecosystem. Let's have a chat. I mean, I'm here and available. John's here and available. Melissa's here and available. I'm sure even Brandon and Danielle would jump in as ex-customers and talk. But yeah, no, look, it's an exciting time. I think it's been a long time coming, but it's ready for it now. So I think we'll maybe call it there.
I've got a quick piece of advice for the entrepreneurs real quick, Ian. So one of the biggest mistakes that we made was not getting a financial SaaS application right when we started the company. So there are a lot of very affordable financial SaaS applications like Baremetrics, ProfitWell, ChartMogul, First Officer, SaaS Optics, MRR.io, Stripe Analytics, and Dunning. These platforms will take all the data from Stripe, from everywhere, wherever you're getting revenue and income, and it will make it so much better and easily viewable on a visualization dashboard. And that way, when you go into due diligence, one, you should be looking at the business data all the time to run your business. I have multiple of those data visualization tools up every day of the week. So when I got into due diligence with John and Melissa and the Lighter Capital team, we knew all of our business metrics, because QuickBooks is so slow to update. And, depending on the billing cycles, you name it, where these business dashboards will track your MRR, your ARR, your LTV, your CAC, your growth rate, your MRR growth rate, everything that you need to be tracking every day of the week. So if there's any piece of advice for the entrepreneurs that are thinking about doing venture debt, it's one, get to know your numbers. Fastest way to get to know your numbers is to get one of these cheap platforms for $100, $200 a month. It will do all the work for you. And then when you know your numbers well, I recommend going for venture debt. If you don't know your numbers, get your numbers straight first, because you won't be ready. And they don't need a lot. They just need P&L and balance sheets and projections and a business plan. But you want to make sure, if you're going to borrow money from people, make sure you know your business, make sure you know your metrics for growth. And if I could go back in time to 2017 when we had the idea, it took us a year or two to find these platforms. I wish we did it sooner. So I hope that helps you. And
yeah, no, absolutely. Well, that's
such a good point, Brandon. And I would say that you were probably more the exception than the rule in having that already, because a lot of we could get loans done in a week if customers had all their data ready, but a lot of what we do spend our time on underwriting is understanding the churn for companies that don't have systems like that in place.
All right. Well, thank you. Thanks, Brandon, Danielle, and John and Melissa. It's late in the day for three of you, so you can go and have a glass of wine, put your feet up. Melissa and I got a full day's work, and I'm sure the rest of the audience do as well. So why don't we all get on with that? But look, thanks to the panelists. Thanks everyone for joining us. And yeah, look, we're here to help. So drop us a note. There should be some contact details in in the registration page, or you'll find us on the website. So thank you.
Good luck, everyone.
Thanks, everyone.
Thanks, everybody.
Thanks, Brandon and Danielle.
Yeah, thank you so much.
Bye.